So what should you do? Well, I'm not your financial advisor. I just put that disclaimer up on the screen. This is not financial advice. Please don't trade off of this. But however, since we're talking about this in a town hall format on YouTube and other social media, I would say look at your budget. Make sure that you're not in a negative situation where you're taking on debt. If you are, try to get out of that if you can. Consult your financial advisor. Go read up on this stuff. But the first danger to you, because it's also a danger to countries, we saw in that research, would be obviously try to minimize your debt and the effect debt has on your individual portfolio.
Welcome to Gold Silver Pros. Searching for the best precious metals deal? Shop with our trusted partner, Arc Silver. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everybody, this is 𝘎𝘀𝘾𝙊𝙈 with �GoldSilverPros.com. I'm recording this on February 16th, 2023, about 11:30 a.m. Central Time. You guys will probably see this on the YouTube channel here this evening. And on this report, I just wanted to do an examination of debt to GDP because we're having a lot of talk about the debt ceiling, as we typically do when the government wants to spend more money. But interestingly, the Congressional Budget Office has come out with a report that we want to review about what they've already done. They've already enacted emergency procedures and what could happen if they do run out of cash. And then we're going to talk about debt as a function of growth in society and inflation, going back to Reinhardt and Rogoff's research that they did 2009, 2010, right after the last crisis, where they showed that too much debt to GDP leads to short-term reductions in growth and higher inflation, which is exactly what we're seeing now. So I thought it was a good time to kind of revisit this and talk about how that may be affecting us now. So let's just jump right into the research. So we're going to start with this report from the Congressional Budget Office. It was released in the same month, February 2023. The report is called Federal Debt and the Statutory Limit, February 2023. And we're just going to go down what's in this report, what's the current situation, what are extraordinary measures, and what can happen once those extraordinary measures and the cash are exhausted. And then we'll get into some charts and things about where we are in the United States right now. So reading from this report from the Congressional Budget Office under title, What is the Current Situation? It says, the Treasury has already reached the current debt limit of $31.4 trillion, so it has no room to borrow under standard operating procedures other than to replace maturing debt. To avoid breaching the limit, the Treasury has begun using the extraordinary measures described below. It's already done that. Continued use of those measures along with regular cash inflows would, in CBO's estimation, allow the Treasury to finance the government's activities until the summer without an increase in the debt ceiling. Part of what they're worried about right now, of course, is the collected tax receipts and how that may affect the situation. One of the reasons they're talking about it now. What are the extraordinary measures available to Treasury that they have already enacted, or at least this is the group of ones they can enact, not necessarily the ones that they have. But just so you know, suspend the investments of the Thrift Saving Plans G Fund, suspend the investment of the Exchange Stabilization Fund, which is the fund that goes in and intervenes in markets to protect the dollar, essentially. Suspend the issuance of new securities for the Civil Service Retirement and Disability Fund or the Postal Service Health Retiree Fund. Redeem and advance securities held by CSRDF in amounts equal to benefit payments, and exchange federal financing-based securities. So essentially what they're doing is they can either swap out certain types of debt for other, or they can stop making payments on various benefits to the rest of the world or to people. So they've already started doing that. When that runs out, according to Philip Soigel, the director who's on this report for the CBO, what would happen? So if we read the section, what would happen once extraordinary measures and cash are exhausted? If the debt limit was not raised or suspended, the Treasury would not be authorized to issue additional debt other than to replace maturing securities. That restriction would ultimately lead to delayed payments for some government activities, a default on the government debt obligations, or both. So what is the chance that we could have a default on the debt obligations? Well, let's go through what researchers have told us, and then we'll go through and talk about where we are. So in a paper written by Carmen Reinhardt and Kenneth Rogoff, this time a different 8 centuries of financial folly, the paperback came out in 2011, but a lot of the research which led to this book came out in 2009, 2010, which I'll show you here in a moment. Who are these people? It was a New York Times bestseller. Who are these people? If you go to the bios of the authors, we'll read them. Kenneth Rogoff teaches in the economics department at Harvard University, where he's a Thomas T. Cabot Professor of Public Policy. Carmen Reinhardt is a professor of economics and director of the Center for International Economics at the University of Maryland. She received her PhD from Columbia University. She held positions such as chief economist and vice president at so on and so forth. So you can go read their qualifications, but they're qualified. And in this book and in their papers, they talk about the point of no return. What is the point of no return? The point of no return is which is about 90%, of debt to GDP. And when you get to 90% of debt to GDP, what this author's research led them to believe is you're going to have higher inflation and slower growth and potentially debt default and debt restructurings. I'm not going to show you all their data. You can go look at it yourself, but I'm going to do a couple of highlights. So here is from a paper that they wrote. It's posted. It's an MBER working paper series. That's National Bureau of Economic Research. Carmen Reinhart, Kenneth Rogoff, working paper 15639. You can access it via that URL. Feel free to type that into your browser. And this is done in January of 2010. And I'm going to go down and look at a couple of charts. The only two that I want to look at are these two. So this is for middle quality government. So we're not talking about the United States here, but just about everybody else who's not the United States, most anyway. This is data collected. Now this line, this purple line here is inflation, and you can see those numbers along the right side of the index. These bars are GDP growth, and you can see those bars at the left side. So we've got two data sets we're graphing. The bars are gross domestic product, or GDP, and the line, the blue line, is inflation. Why? Because that's the two things that they were looking at for the study. You can see, and down here is the debt to GDP percentage. So on the left is below 30, 30 to 60, 60 to 90, and above 90. 90 is their point at which they see a lack of growth and high inflation. So we see high inflation here when you get to 90% debt to GDP, and the average growth rates go negative, meaning growth slows or stops or goes negative, and inflation goes up. So once you have once your debt level for your nation reaches 90% of what you produce in a year, it slows things way the heck down. Now, what has it done to the United States? Well, back in 2010, they took measurements of what had happened during the financial crisis and after. And once the United States, with the world reserve currency and the ability to issue the most well-respected treasury debt in the world, had a much bigger loss, or I'm sorry, had much lower inflation. Let me say this again. Start over. The United States, which had the world reserve currency, okay, and the highest quality debt in the world, if we look at the bars are GDP growth. You saw a larger than average reduction in GDP growth than we saw for the rest of the world using the same data. The rest of the world went slightly negative at 90% debt to GDP. The nation that has the world's reserve currency and the most respected treasury debt in the world did much worse, I think, if you look at the numbers. This was down not even a negative % in terms of GDP growth. This one was down almost negative 2%. So it's interesting that the U.S. had the world's reserve currency and the most respected treasury debt in the world. But when we got to 90% debt to GDP during the last crisis, our GDP fell further than average and our inflation rate rose higher than average. We rose over 6% inflation, which is the blue line. And for the rest of the countries, the middle income countries, most of the rest of the world, it was only 4%. So the US is even more potentially susceptible to high levels of debt to GDP, I think probably because we have the world reserve currency and because we have the most respected debt in the world that everybody pays attention to and relies upon and is used to facilitate international trade, that the effects of when this happens to the dominant, the nation with the dominant economic system, the dominant political system, the dominant currency, and the dominant debt issuance in the world sees a bigger reaction. So where are we exactly in terms of debt to GDP? Well, thankfully, the Fed, which is the database for the Fed, puts out this data. This is at the St. Louis branch. Each branch kind of does their own different studies. This is the one over debt to GDP. You can see at one point during COVID, we were at 134% of debt to GDP, way past the point of no return of 90. And when we started, we're at 107. So we added 27% debt to GDP in a vertical move here during 2020, during the pandemic. This is a temporary shutdown, and this is the largest move in history dating back 50, 60 years. So the pandemic, we issued so much debt, more than we issued during the 70s and 80s inflation crisis, more, okay, than we issued during the last financial crash, more in a short period of time. And we're still, even though we're working some of that off, the debt to GDP, it's come down. We're still at 120. So the academic paper says 90. That would be right here, which we crossed right after we went through the last financial crisis. We hit the point of no return in which we could have expected higher inflation and bigger effects with regards to GDP growth, because according to the chart, this is the rest of the world when that happens, 90% debt to GDP. This is the US when that happens, 90% debt to GDP. So during this whole time, there's no point at which the government, the Congressional Budget Office, Congress, the president, anybody in government could have said, well, this paper from these two academic researchers, which was a New York Times bestseller, came out in 2011, looked at the last situation and history, not only for the United States, but the world, had issued these charts in papers printed at Princeton and on their websites and promulgated through the book and the New York Times. So why would it be a surprise that now we're starting to have high inflation and talk about whether we can deal with the debt? Because that's exactly what they said here. They said that restriction would ultimately lead to delayed payments for some government activities, a default on the government's debt, or both. And we already know we're having high inflation. We just had another high inflation print, the CPI. So how could anybody in the government not have known what would happen when we had this wonderful paper when we were printing all this money? I think we did know. And I think if you're outside the government now, you know by watching this video, and now you may want to think about what possibly you could do. Well, ladies and gentlemen, it gets worse. We have this thing called unfunded liabilities. Those are the future obligations of the U.S. government for social and warfare type programs, for spending, basically, for guns and butter, if you will, whatever you want to call it. Projected out in 2053, we would be at 200%. So more than twice the number at which we would expect to have slowing GDP and high inflation. Ladies and gentlemen, we're never going to get there. I don't care if we have the world's reserve currency with all the de-dollarization going on in the world. We're not going to make it to 2053 at the current pace that we're on. At some point, you got to pay the piper, and this is going to stop. And I'm going to talk to you about that in a moment. But this is a nice little chart. It's on an article at Zero Hedge, but projecting out the numbers, just using the existing data projected out. This is not made up. This is a projection if we go the same direction we're currently going, without talking about an explosion of unfunded liabilities, without talking about if we were ever to get into another war, God forbid, or have some other black swan. This is just current conditions. This is not saying between now and 2053, anything else bad happens, banking event, whatever. This is just assuming now, current situation, which, you know, looking 20 years out in the future, or 30 years out in the future, 2023, 2053, I'm not so sure that there's not going to be some other world event, financial, political, cultural, or otherwise, that doesn't make this situation even worse between now and then. Because look at how often we have recessions. These gray bars are recessions. Does anybody think we're getting to 2053 without another one of these? I don't think so. All right. Moving on to what that's done in terms of credit risk. This is the USA Sovereign Credit Risk Ranking Tracker. And you can see that it's been elevated at times in the past. All of these I could link to not only the past financial crisis, but also the events leading to the past financial crisis and how much money we printed in TARP and the bailout programs. I think the world saw risk here, and then it kind of came down, and it was sort of normal distribution for a while. And then what happened in the pandemic spiked it just a wee bit, just a bit, but not much. But then what has happened this year has caused it to spike vertical. And the biggest move I've seen in this index dating back to 28, this was a pretty big move. This is a bigger one. This is a pretty big move, but it started here. This is the biggest move I've seen in the sovereign credit risk dating back before the mortgage crisis in Lehman 2008, 2009. What does that tell you? It tells you because of the increased debt to GDP that we have and the inflation rates that we're seeing and the research done here, and the U.S. apparently being more sensitive to high debt to GDP than all the other countries in this study. Of course, it's done in 2010, but this was done 1946 to 2009, okay, 1790 to 2009. So the U.S. over a larger data set has more sensitivity to higher debt to GDP than does the rest of the world, probably because we are that nation which has the highest, the world reserve currency, the most respected debt, all of that kind of stuff. We were the shining, light on the hill, and we were leading people into the free world. And so I think that's part of the reason it's even more sensitive to our overall levels of debt than maybe other countries, because other countries could get bailed out by the IMF or by us. Who's going to bail us out if that system collapses? If we go through a major financial disruption and a system collapses or a black swan, I don't know that that data shows that we're going to do better in the U.S., or maybe we might actually do just a tad worse. We're going to have to see. We haven't actually had a debt default yet. We've just had debt issues, but debt issues with concern when it gets to a certain level of our gross production and product. You have to look at that and say, that could be a potentially big issue for the United States, especially since it seems like we're a little bit more sensitive in that sensitivity. I could call that a sensitivity analysis in a Reinhardt and Rogoff's paper that they wrote back there in, I think it was 2010, and which is printed at the National Bureau of Economic Research, NBER. So what should you do? Well, I'm not your financial advisor. I just put that disclaimer up on the screen. This is not financial advice. Please don't trade off of this. But however, since we're talking about this in a town hall format on YouTube and other social media, I would say look at your budget. Make sure that you're not in a negative situation where you're taking on debt. If you are, try to get out of that if you can. Consult your financial advisor. Go read up on this stuff. But the first danger to you, because it's also a danger to countries we saw in that research, would be obviously try to minimize your debt and the effect debt has on your individual portfolio. Then look at things to stabilize that portfolio and reduce risk. I'm writing a series of risk management for Jan Bullion at janbullion.com/blog. I've got 2 articles up out of 3. I'll do a third one, which talks about risk. Go read those articles on risk. You want to apply risk to your portfolio of investments plus risk that you may want to alleviate with your portfolio of investments, and then do a risk assessment after making those choices and determine for yourself, did you adequately adjust the risk? And that's an individual decision. I cannot do it for you, but think about that. Read that risk management series. Consider the possibility of precious metals in your portfolio only because it doesn't have a lot of counterparty risk, and it's one of the few things that don't, gold and silver. But also look holistically and wholeheartedly at your portfolio and make decisions for yourself. Don't just go buy a bunch of gold and silver. Determine what's best for you, and maybe even look at other alternatives in the market as well. We certainly like gold, silver, but there may be others that you decide, investments or assets that you decide reduce your overall risk levels, or you may decide to go to all cash, or you can do whatever you want. That's up to you, but just look at it. I think now is a good time to begin looking at our budgets, to begin looking at where we stand individually, to use that research that I brought to you over how the financial health of nation states affects the nation state, and say, okay, we're looking at that. Do I need to do that for myself? What's my own debt to GDP ratio in my own household? What investments have I made? What other defensive strategies have I done? Maybe it's just buying more food. Maybe it's reducing debt. Maybe it's getting a better job and increasing your skill set. However you want to address that situation is up to you, but just consider the research and do what is best for you and your family. Thank you guys so much for paying attention to this broadcast. We will see you next time. This has been Rob Kientz with Gold Silver Pros.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.